All right, well then, with that, we will get started. So we are going to be covering everything that at least I had learned up to the final. So again, if there's anything that we have not yet covered in Lander's class, please let me know and I'll skip over it because I took the class with Lincoln Zoo. So the first thing we are going to start with, if someone could just let me know that you can in fact see this before I get going. We're just gonna briefly graze over all of the topics that we'll cover today. Perfect, thank you. So we will start with consumption constraints and your budget lines. And of course, we'll go through some examples there regarding taxes, food stamps, resale discounts, multiple constraints, which of course can be multiple variety of constraints. And then of course, opportunity cost. Then we'll move on to consumer preferences and utility, weak versus strong, all the things you learned when you first started the class. Indifference curves, utility functions, marginal rate of substitution, technical marginal rate of substitution. If you all learned them, they're the same exact thing. And then some of the special cases there, as well as axioms, marginal utility, and then more complicated special cases, or your typical Cobb-Douglas utility function. And then we're going to move on to your consumer choice and optimal bundles. We'll cover primarily Marshallian demand functions and corner solutions there. We'll cover some of the types of goods. Then we're going to move on to demand, whether that be price offer curves, demand curves, income offer curves, and Engels curves as well. And we'll touch on price elasticity and income elasticity. Have you all covered the Slutsky and Hicks decompositions? Because that was a solid chunk of my final. And then once we cover those, we'll go into consumer welfare, measuring the net effects of consumer welfare and some changes, compensating variation, equivalent variation, consumer surplus. Then we'll go into some of the examples that we have of buying and selling, whether that be with endowments, labor supply curves. And then we'll close with some inter-temporal choice problems. So that would be something like loans and savings and inflation and real interest rates. Then we'll close with exchange, I should have said. And that's going to be things like your, what is it, Edgeworth box, yeah. So here we have the glossaries for some of the more complicated cases, whether that be Hicksian, Slutsky, compensating variation and equivalent variation. Those are just the formulas and basic things that you should understand. We'll go back to those a little bit more in depth here. So we're going to start with consumer constraints. So constraints basically just limit a consumer's ability to purchase goods, and there may be multiple constraints of many different variations and forms. So the budget constraints are the most common that you're going to see, although your professor can get creative with different types. You're just going to treat them all as you would a budget constraint. So don't let yourself get confused on the final exam regarding those, any sort of wordplay that he does there. Basically, consider a consumer's disposable income, or budget constraints consider consumers' disposable income and commodity prices. And the budget set contains all affordable consumption bundles and is just bordered by the budget line. We've got the definition there and some important equations that you should understand. Price of good one times the quantity of good one plus price of good two times the quantity of good two must be less than or equal to your budget constraint, or yeah, your budget constraint. Then we have the formula for the budget line, which is the same exact thing, except it has to be equal to your budget. And then therefore we have, if you like a slope intercept form, we've got your slope being negative price of good one divided by price of good two. And then of course you just have to multiply that by your quantity of good ones and subtract that all from your budget divided by price of good two. And that's going to equal the demand for good two. We have the diagram there. That's basically everything you need to understand about the budget set, whether that be just representing all your affordable bundles, just drawing the intercepts where your x2 intercept, the horizontal and vertical intercepts are just going to be dividing your budget by the amount of goods that you are demanding for that. Then any change in income is going to lead to a shift in the budget line where your slope remains the same, but your intercepts change. Any price change is going to lead to a rotation of the budget line about the axis of the good that changed with its price that changed, and the slope is going to change for those. So we got the two diagrams there. We've got an increase in your budget and a decrease in price for good one, just as examples. We'll also cover some of the different tax problems that we will have here. It's pretty likely, and I guess at the end of this, we'll go over some problems, or I'll send you all some of the old exams from Lincoln Zoo. I'm not sure how much that would help you. I'm not sure if your final will be multiple choice again. But again, Lincoln did not have any multiple choice problems on his final. I think I've got 6 years of those, so I'll distribute that in the group chat after this is done. The main types are going to be ad valorem and value added tax, or VAT, and then you're going to compare that with excise tax or per unit tax. So your VAT tax is basically just a percentage tax on each unit purchased, where your price of good one, the new price of good one, is going to be equal to your previous pre-tax price of good one times 1 plus the tax rate. And that is going to be for only a tax on good one itself. Your budget line is going to change, so that's just going to become the quantity of good one times the price of good one, and you're just substituting, again, you're just substituting P prime in for P from the previous equation. You have 1 plus the tax rate plus quantity of good two times price of good two equals your budget. Excise tax or per unit tax is going to be a tax on a set amount of dollars per unit. So that's just going to be P1 prime, or your P1 after the tax has been implemented equals price before taxes plus the new tax. And that is, again, only for a tax and good one. You're just substituting that back into your original budget line. You're going to end up with quantity of good one times price of good one plus tax plus quantity of good two times price of good two equals your budget. Common applications, at least that we saw last year, were going to be your food stamps pre-1979. We use 1979 because legislation changed the way that food stamps worked. You can see how it changed reflected in the graphs. So pre-1979, you got a discount on the first 10 food items in your trade-off between food and housing. Food stamp case is very similar to taxation and quantity discount. However, you see that there's a kink in the graph right there. The formula for the top, that beginning right here, if you can see my cursor, is just going to be negative discount price of good one divided by price of good two. And then the remainder is just this formula right here. And again, that's the trade-off between food and housing. But if you're looking at the post-1979 case, which is just going to be similar to rationing and multiple constraints, you'll see that the stamps shift outward, and we're just moving this curve, again, the same exact formula is just being shifted outwards because you get this amount right there. And again, that's the trade-off between housing and stamps, because the first 10 food items are free and you can't resell them. If you can resell them, you might see a problem with that. It changes everything. And the slope will remain the same, but the housing intercept does not change. We'll move on to preferences and utility. We'll just cover that pretty quickly here because I know you all have that down by now. So preferences describe how a consumer ranks all possible consumption bundles. And we got two forms of notation. You got weak preference notation and strict preference notation. And of course we have indifference as well, but translation between the two forms is possible, simply because indifference occurs where two bundles are at least as good as each other. Now we'll cover some of the axioms as well, starting with completeness. Basically, completeness just says that any two bundles can be compared. Reflexivity says that any bundle is at least as good as itself. Transitivity says that if X, good X, is at least as good Y, and good Y is at least as good as good Z, then good X is at least as good as good Z. Now, if you have completeness, reflexivity, and transitivity, the consumer's preferences are said to be rational. Weak monotonicity, regular, strong, as well as the convexities, and we'll just go to the next page real quick here. Yeah, and continuity, if you have all of those on top of the rational preferences, your consumer is said to be well-behaved. So again, weak monotonicity just basically says that more never hurts. Regular monotonicity says that more of everything is strictly better, and strong monotonicity says that more of something is strictly better when all others have at least the same amount. And again, you don't really need to understand the phrases that I just said, as long as you understand that, weak monotonicity, your indifference curve is never going to be upward sloping. Regular monotonicity is never upward sloping or thick. We can cover that in a second if anyone is not clear about that. And then, of course, you have strong monotonicity, just saying that the indifference curve is always downward sloping. Regular convexity can be a little bit harder to understand your first time looking at it, but I think it's a little bit easier when you're looking at it graphically, at least. Basically, all that this is saying is that when averaging two bundles that are at least as good as any reference point on your line, or on your curve, I should say, the outcome, this outcome average, will also be at least as good as the reference point. The indifference curve is going to be negative, or excuse me, the slope of the indifference curve is going to be negative and is also going to be increasing or linear in order for regular convexity to apply. So here we have an example of, again, if you can see my cursor, where regular convexity does apply, but in this example, strict convexity is also going to apply, because this average point, that red one in the middle of the red line, is greater than our reference point Z. Whereas for regular convexity, if you have a line, regular convexity does apply to a linear function simply because it's at least as good. And you'll see that on your indifference curve there, that red point has the same utility as that black point Z. We'll move on to strict. We basically covered that already. So we'll move on to continuity then. And again, continuity, you don't really need to understand that in depth simply because it's kind of trivial and complicated at the same time. But it basically just says that every bundle is a sequence and that at least as good as the reference, then the limit is also at least as good as it's continuous. We'll move on to utility. Just you see the mathematical approach representing consumer preferences there. I won't cover that because we really already covered it. And the consumer preferences can be represented by a utility function if they are complete, reflexive, transitive, and continuous. Utility does not have to be a positive value, and it's just a measure of a consumer's level of happiness. An indifference curve can be generated with described preferences or by setting a utility function to a certain utility level. Now we'll cover some of these special cases. The ones that we have on this page are the easier ones. So we'll be looking at perfect substitutes, perfect complements, quasi-linear preferences, and Cobb-Douglas preferences. We have the formulas for each of them there. These notes will be posted. I won't cover that too in depth, but the moment this ends, I'll send this out to all of you and you guys can look it over and take whatever you want from it. We also have marginal utility, which is of course vital to calculating the marginal or technical marginal rate of substitution. So you have your marginal utility of good X is the partial derivative. Are you all in the Facebook group chat? Because if that works, I can post them right there. But if not, I guess we could figure something else out as well. Just let me know if that works. I also know that there is a WhatsApp chat, so I can do both of those. I don't know if you're in both or either of them. Are you in either of the chats? All right, perfect. Omar? All right, let's see. So then why don't you just stay briefly after I conclude this. I'll upload it to Google Drive and I'll send you a link in the chat for anyone who's not in either. Perfect. All right, great. Of course, yeah, just let me know if anything like that comes up and I'm happy to help. So we'll cover marginal utility as well. We started a little bit there, but basically that's just marginal utility of good X is the partial derivative with respect, or the partial derivative of your utility function with respect to good X divided by the partial derivative of good X where Y is held constant. And this can be graphed for a single good to demonstrate diminishing marginal utility. So if your prof asks for a proof of diminishing marginal utility, that's going to be the first thing you do. And if preferences are strongly monotonic, then marginal utility is going to be strictly positive. Utility is an ordinal concept, as we said before, but we can give it a cardinality by relating it to marginal rate of substitution. So you just have your marginal rate of substitution of good 1 and good 2 equals the marginal utility of good 1 divided by the marginal utility of good 2. And just remember that that is always negative. And that makes sense, right? Because our slope is always going to be negative. Now we'll go a little bit into consumer choice and the optimal choice equation, or I should say problem, and optimal bundles. So a rational consumer will always select their most preferred bundle within their set of feasible bundles, typically the best affordable bundle. Thus, a consumer will seek to maximize their utility such that they remain on or within their budget set. Assuming that preferences are either regular monotonic or strongly monotonic, the optimal choice will always be located where the indifference curve is tangent to the budget line. And this tangency point occurs where the functions intersect and have the same slope. We'll break that down a little bit more mathematically just to make it easier to understand, especially some of the concepts in this course can be a little bit tough if you haven't taken a Calc 2 or Calc 3, or I should say Calc 3, I guess, later on in the course. But I try to break them down for you all just to make it a little bit more simple so that if you've taken Calc 1 or Calc 2, you should be able to understand it. So to determine the optimal bundle, one must complete the constraint to choice problem, and this can be solved with calculus via basic optimization, or it can be solved algebraically with the optimization condition. This condition satisfies the slope requirement of tangency, and here you have the condition. So marginal rate of substitution is going to equal your marginal rate of, marginal utility of good 1 divided by your marginal utility of good 2, which equals your opportunity cost, which equals negative P1 divided by P2. Thus, for the requirement of tangency, this condition to be satisfied, your marginal utility of good 1 over your marginal utility of good 2 must equal your price of good 1 divided by your price of good 2. So if you're looking to solve for the Marshallian demand function, I've got a breakdown right here for you. These steps are going to be identical every single time. So once these notes are posted, you can just go back, review that. It's pretty simple in itself and doesn't require too much other than memorization. So here we have these special cases a bit more in depth, just the formulas for solving them themselves. We'll start with perfect complements, where this blue line is the most important thing that you're going to be looking for. The equation there is going to be the quantity of good 2 equals alpha times the quantity of good 1 divided by beta. And this is the function for that. It's a Leontief function, where you're taking the minimum of alpha x1 or beta x2. And then of course, once you have that, this line, your optimal choice is just going to be the intersection between your blue line right here and your budget line. Perfect substitutes. Again, we have alpha x1 plus beta x2, and optimality will be a corner solution unless marginal rate of substitution at some point equals negative price of good 1 divided by price of good 2. Because the consumer will want to spend all of their income on only one of the cheaper goods if there is a corner solution. So we have a case here where there is a corner solution. This is what it's going to look like graphically. And of course, you can tell that it would never be an optimal choice lying on the budget line within positive x1 or positive x2. Quasi-linear functions are a little bit harder than the above two. The above two are pretty much the easiest possible cases you might get. But when you have quasi-linear functions, it may or may not yield a corner solution because quasi-linear always crosses one axis, or at least one axis, I should say. Here, the budget line slope is greater than any marginal rate of substitution from the utility function in, what is that, Q2? Yeah. So you see there, we have one case where there is not a corner solution, and then you do have a corner solution in this case. And corner solutions can be identified when you have problems like this. You can identify them almost immediately just looking at your Marshallian demand function. And you can try to figure out wherever the Marshallian demand function might yield a negative value. So if it's possible for your Marshallian demand function to yield a negative value, where, for example, quantity of good 1 when it's optimized as negative, all income would just be spent on good 2, where your optimality for good 2 is negative. Vice versa, where your optimality for good 2 is negative, all income is spent on good 1. Then we have the simplest, or not simplest, but your most common case, just Cobb-Douglas utility. You're just going to be locating the Marshallian demand function using the steps that I wrote up above in the previous slide. That'll give you both Marshallian demand functions, then you can solve for your optimal bundle. The formula to obtain marginal rate of substitution for a Cobb-Douglas function is right here. So basically, when you have Cobb-Douglas, you can there's a shortcut just using this formula to get to it, because all Cobb-Douglas utility functions, as long as you've accurately identified that you were given Cobb-Douglas, you can cheat straight to the marginal rate of substitution. Now we'll cover some of the types of goods really quick. You have ordinary goods, normal, inferior, Giffen, and Veblen. Please let me know if you've not covered any of these, because I don't want to waste anyone's time. But an ordinary good, the relationship between a good's price and demand is constant. Price and demand have a negative or positive relation, and this includes normal goods and inferior goods. Normal goods, the demand for a good increases when income increases or price decreases. It also increases if purchasing, or also increases in purchasing power means greater demand and is always ordinary. Inferior goods, the opposite of a normal good, increases in purchasing power or rise in income or decrease in price lead to decreased demand, and this can be ordinary or Giffen. You'll notice for the Giffen and Veblen goods, they are distinctly different. They look very odd. Not ordinary and is a very inferior good. Above a certain price point, demand will decrease, but below this same price point, demand will also decrease. The latter occurs when the good is inferior and becomes so cheap that a consumer would rather spend their money elsewhere. So an example would be steak and potatoes here. That's the typical example that I don't know if Lanyard gave you, but Lincoln always relied on. The potatoes are going to be a Giffen good. Veblen goods are not ordinary and are very normal goods. Above a certain price point, demand will increase, but below the same price point, demand will also increase. These are luxury goods where a high price becomes a valuable social statement and is the opposite of a Giffen good. So here we have some examples of demand curves, just given certain cases, specifically regarding homothetic examples. So whether you have a change in income or a change in the price, we'll see here that you have the Engels curve, which has an upward slope for normal goods and downward slope for inferior. Normal offer curve, where you have all your different budget lines and all the different optimal points. And inferior case for good one, where you have so that's your demand, and then you have all the different budgets that could come out of the case scenario. So if we look at your homothetic example one, income changes and perfect complements, you'll see here that you have a kink at X1, or demand for good one equals demand for good two. And then you can look at the income offer curve right here, as well as the inferior case. And these are all things that you should kind of just memorize, do like one practice problem with them. I've laid them all out here for you. I think there are a few more on the next page, but nothing too crazy there. We've got the quasi-linear example, and then we switch over to price changes where income is fixed. That's a good point, actually. So up here we have income changes where prices are fixed, and we have the Engels curve, income offer curve in the inferior case. And then below here, it just flips over. So we got price changes where income is fixed. The important thing to remember here is that price offer curves are found by isolating a single price in one demand function and then plugging it into the other. We'll cover elasticity as well, but basically elasticity is the sensitivity of one variable to a change in another. So for example, the elasticity of good Y with respect to X is just going to be your percentage change in good Y divided by your percentage change in good X. We have that just denoted via calculus there. And of course, this means that basically one price elasticity demand of good one is going to equal this. And that's just saying that your marginal change in demand resulting from a marginal change in price. Yes, all of these videos will be posted. I'm pretty sure they should be posted to the ESA YouTube account, but just to be sure, I will send a link for the YouTube account as well in the group chats. We're all the same places that I send the notes, so you all will have access to this afterwards. Of course. And then you have the income elasticity demand of good one. And these notes actually helped me a lot when I used them. Just go back, a lot of the things I've just written out, like every single possible case scenario for the problems that at least I was going to see. It's very possible that Lander covered something that is not in my notes, so don't rely on my notes 100%, but at the same time, these are pretty solid. So in terms of Slutsky and Hicksian decomposition, we're going to be looking at these when a price of good changes, because that affects the consumer's choice in two ways. First, we see the substitution effect. We also see the income effect, but the substitution effect measures the consumer's substitution between their options, given a price increase or decrease. The substitution effect will always have a negative relation with price change. So as price increases, the substitution effect is going to be negative. The income effect measures how a consumer's price changes as the isolated result of changed purchasing power. The income effect has a negative relation with price for normal goods, but a positive one for inferior goods. Now, the Higgsian and Slutsky decomposition are two methods that can be used to isolate and measure the substitution and income effects. This can get a little bit more complicated in terms of graphing, so I'll zoom in there for you all. And again, once I upload these, you can review them a little bit more in depth. I don't want to run over an hour here, but basically I'll cover these formulas in brief. You have the total effect equals your substitution effect plus your income effect, and that's always true. While your substitution effect equals your change in the demand for good one, which equals your change in demand for good one, Hicksian minus your change in demand for good one. Same exact thing for your income effect as well, and you'll see that those are similar concepts down and below. So whether that be a Hicksian or Slutsky. So basically, just in brief, the Hicksian, also known as the compensated demand function, yields point C right there, given the ordinal utility and new prices. So that's basically just saying that the compensated demand function is going to be your demand for good one as a function for utility, new price of good one, and new price of good two. Whereas for Slutsky, you have your original point and final point B, A and B are compared to the Slutsky decomposition point C. Slutsky demand is calculated through the original choice and with final prices. it is said that the purchasing power remains the same as A is still just as affordable. Utility will change. And in case of an inferior good, a price change will yield an income and substitution effect of opposite signs. So that was something that was important to know for my exam. When the income effect is greater than the substitution effect, the income effect dominates. Then the good is not just inferior, but is then also given. So once the income effect dominates the substitution effect, you no longer are focusing on an ordinary good. In the case of an inferior good, which is exactly what I was just talking about, we will look at it completely different. So for the Hicksian decomposition, as the price of good one decreases, so does demand for good two. Therefore, your demand for good two therefore good two itself is an inferior good, your income effect is negative, and your substitution effect is positive. But at the same time, the absolute value of your income effect is going to be less than the absolute value of your substitution effect. So your demand for good one is not good one itself is not a given good. In the case number 2 we have here that I've written up, we have as price of good one decreases, so does the demand for good one. Thus, good one is an inferior good. The income effect is negative. The substitution effect is positive. You have the income effect, absolute value of the income effect is greater than your absolute value for the substitution effect. So good one is also a given good. The compensated demand function seeks to minimize disposable income required to maintain the previous utility level with new prices. So basically when you have compensated demand, it's going to mean that you have the same exact utility, but you're going to have a different outcome in terms of M, the variable that I'm using to denote, budget. It's your income. Let's see. If you are looking for your minimum expenditure to either maintain, for example, if you want your minimum expenditure to maintain your previous income, you're going to be using this formula. And that formula is just going to be yielding the minimum amount of cash that can be used to obtain a required level of utility. Now we're going to touch on consumer welfare measurements. So an increase in utility given a price or an income change is a welfare gain. A decrease in utility amounts to a welfare loss, yet we cannot directly compare between the two consumers. In order to compare utility, which is an ordinal concept, as we have said many times before, in order to compare utility between two consumers, we need to give it some sort of cardinality. Cardinality is basically just referring to magnitude and makes them comparable. So the method number 1 of doing this is going to be looking at consumer surplus, which is accurate for all quasi-linear utility, but just an estimate for other cases. So I've graphed it here for you where the red area is the consumer's expenditure at a given choice, and the green area is the consumer surplus. And it can be calculated with integration, or if you have a linear demand curve. Well, I guess you'll never have a linear demand curve for a quasi-linear function, but it can be estimated as well, as was my point. You're just going to be looking at the difference between your price 1 and price 2, so that would be this area right here. Horizontal integration may be required in some cases. So just remember how to do that, and that you might have to do that. So if you try to integrate that vertically, obviously you're doing something wrong. And the second method is just looking at compensating variation. And this is going to be accurate for all utility functions, not just quasi-linear. It is a measure of cash compensation required to restore the consumer's original utility. This can be expressed as a minimum expenditure minus your disposable income. So we have the formula there for compensating variation, and compensating variation can be demonstrated on the Hicksian decomposition. So that's the connection right there between consumer welfare measurements and what we saw above in terms of Hicksian and Slutsky. You can use Hicksian composition to evaluate your compensating variation and compare your consumer welfare measurements between all utility functions, rather than, as we saw in example 1, just the quasi-linear utility function. The third method is going to be looking at equivalent variation, and this is going to be accurate again for all utility functions, and it uses the original prices but a new disposable income at the final utility level to find a required cash compensation amount. So we have your formula there for your equivalent variation, where your good number 2 is often a composite good. If your equivalent variation is greater than 0, you have a welfare gain. If your equivalent variation is less than 0, there is a welfare loss. And basically, any policy change that leads to a price decrease will also lead to a demand increase for normal goods. If you have a price increase that leads to a demand increase, a price decrease will lead to a demand decrease. The 3 methods will yield magnitudes in the following hierarchy. Yeah, so this was also something to understand, just the relationship between the 3 methods. Of course, your method number 1, consumer surplus, can only be used for quasi-linear functions. We'll cover buying and selling a little bit. If at any point someone could let me know how far you've actually gotten, what you've covered most recently in the course. I just want to make sure that I'm not covering stuff or confusing anyone with topics that you all have not looked at. But when we're evaluating the buying and selling, perfect. Buying and selling, we're going to be looking at endowments. And an endowment is just the resources that a consumer possesses before engaging in buying or selling activity. This will now expand upon the disposable income concept, and as such, our revised budget line is going to be equal to this, where we have replaced M, or your budget, with the endowment itself. So, and if we want to, yeah, exactly. So W1, which is the endowed sum of X1, W1, W2, is called the endowment point. And the endowment point is always on the budget line. So that's going to be your starting point. The idea here is that we can actually move along the budget line itself, rather than just having to stay at a certain spot. A consumer's net demand for a good is their consumption minus their endowment. The budget line can then be manipulated to reflect this form, the formula that we have right here, where these are net demand functions for good 1 and good 2. And then your gross demand in terms of price is always going to be equal to 0. When net demand is positive for a good, the consumer is a net buyer. Meanwhile, when net demand is negative, the consumer is a net supplier or a net seller. Buying and selling allows consumers to move along their budget line and achieve optimality, just gives them a little bit more flexibility. As you can see here, when prices change, the budget line will now rotate around the endowment point, and the price offer curve runs through all optimal choices given price changes. So if we're looking at possible applications that you could see in your exam, the worker's choice one is a very popular one. But basically, this is an example where a worker is endowed with a non-labor income M and available time R bar, where W equals R bar, or W is a function of R bar and M. The consumption good, typically a composite good, has a price of P1, W is the wage rate, and R is the time allocated for leisure. So there we have the worker's budget constraint, where you have the formula or budget line, and it's pretty similar to the concepts that we saw earlier in the course. But you can see here at the endowment point, it cuts off where M is divided by PC is or it cuts off where C is less than M divided by PC. And we intersect at our vertical intersect is going to be M plus W times R bar divided by price of C. And this is the trade-off between leisure and labor. We can also evaluate the backwards bending labor supply curve in the case where leisure behaves as a given good, and this can be demonstrated via a Hicksian composition. So we have the general case right here. So as wage increases, we see rotations around the endowment. And then over here with the labor supply curve, again, it's a given good. We also see overtime wage case, where as you work wages or you work hours beyond a certain point, you start getting paid time and a half, which is the law in states like New York City. So overtime wages begin at R to the A, and Slutsky uses the new wage through the endowment point. Hicksian uses the new wages tangent to the original choice, i.e. as a function of A before overtime. We can also look at the income taxation case, which is opposite to the graph above, and we can see the Laffer curve right there. The Laffer curve is just a function of tax revenue as a function of tax revenue and tax rate. So basically that's just saying that there is an optimal tax revenue and tax rate. Intertemporal choice is the last thing that we're going to cover. And now we're just factoring time into our choice as a consumer. So in the case of buying and selling, when a consumer has two consumption periods and can either save or borrow between them in order to achieve a higher utility level. An endowment exists as the lump sum for each period, and we will look to maximize consumer utility given an endowment in periods 1 and period 2 as a function of W1, W2, and yield the optimal consumption bundle in periods 1, then period 2. We're going to denote the optimal consumption bundle in periods 1 and period 2 as C1, C2 respectively. So saving the period 1 endowment for period 2 will often provide passive income cash flow according to the determined interest rate, which we will denote as R. In the case of saving tangible assets, devaluation may occur in some examples at a given interest rate R. Borrowing from the period 2 endowment for consumption in period 1 often requires financing at a given interest rate R. Present and future values are necessary to investigate the value of an asset over a given period with a given interest rate. So regardless of saving or borrowing, your present value is going to be equal to your W2 divided by your 1 plus R. Future value is going to be W1 times 1 plus R. So if you've taken any finance course, this is going to be, or at least the concept of present and future value is going to be very trivial to you. And if you have not, it's something you should get used to. It's something we'll see all the time, especially if you're doing the joint honors economics and finance program. Here we'll see the MPV, which is going to be, or your net present value, I should say, is going to be equal to W1 times P1 plus W2 divided by 1 plus R. So again, that W2 divided by 1 plus R is going to be your present value, and then you're just going to be multiplying that by the price of good 2. This somewhat resembles the mechanics of discounted cash flow. If anyone here wants to go into investment banking or wealth management, that is something that you should also get used to. Just moving on, the intertemporal budget line can be expressed in terms of present value or future value. So I have the formulas for both of them there. And it's important to remember that assuming endowment and consumption are composite goods, period income and expenditure. That's the assumption that we've made in both of these formulas. When dealing with tangible assets, it is important to include prices in the budget constraint. So again, we have that exact thing right there. And in the presence of inflation at rate pi, price of consuming a good will increase accordingly over a period. So we can look at our intertemporal choice using these formulas if we have some sort of interest rate and if we have some sort of inflation rate as well. Of course, these will work to counteract each other most often. So the intertemporal budget constraint with price inflation is going to be equal to the formula down here. It's important to understand there that price inflation does not change on the endowment side. So if you have a real interest rate rho in the rate of inflation's effect, you've got rho equals R minus inflation rate divided by 1 plus inflation. This is going to be your real interest rate. That's something you'll see in classes like international business or finance. It's going to come up again if you are taking the joint honors program. And the intertemporal budget constraint is represented graphically here, where we have the future value function, your slope, net present value, and your net future value. So again, the mechanics here are relatively similar to what we learned in the first few chapters, and then we added on top of that buying and selling, and then we added on top of that intertemporal choice where you can buy or sell within and across periods. But a lot of the concepts are similar. It's just something you really have to get used to via practice. And we've got more formulas here for you all. So common intertemporal budget constraint variations. We have the full form for present value notation, future value notation. We've got the case for income tangible good consumption, the case for tangible good endowment and tangible good substitution, or excuse me, tangible good consumption. And then the last case for general cash investment with price inflation. Now, a lot of these formulas, oftentimes you will see a variation of them, or a similar variation, I would say. So for example, if you're looking at this, maybe you don't have any inflation present and you can kind of ignore. So like these terms right here, and it just simplifies. But again, this is in full form. So if you were given any sort of problem on intertemporal value, you should be able to apply with some respect this formula. If you don't recognize that, you know, maybe you can reduce, or there's no inflation present, you can reduce. When we're looking at inflation, it's important to remember that price inflation only affects the consumption price of a good and leaves income untouched. General cash inflation affects both the endowment and consumption price. Finally, we've got exchange and competitive markets. I assume that this is the last thing that you covered because it's the last thing we're going to be covering today. Consumer welfare analysis for free trade. So would that be this? Did you cover Edgeworth boxes? Because I know Lincoln might have taken us a little bit over. We did not cover it, right? Perfect. Good for you all. You guys got lucky. I don't know if you'll cover it. Perfect. I appreciate that. Yeah, so I assume you might cover this with Professor Dutta, but this is completely different. So yeah, it's probably a good thing that I did not get to this because it's a completely different subject. It has pretty little relation to the previous. I will not cover it or confuse you all. So yeah, that's really all we're covering today. I'll send everything that I have here in the group chats. I'm going to stop recording, upload it to Drive right now, and just send it in the chat here on Zoom. So if you are not in the group chats and you want access to these notes, I will send this to you right now. Let me know if you guys have any questions, and thank you for coming.